Hi, everybody. This is Alan Ellman, the Blue Collar Investor, with BCI Podcast number 31. This one is titled, What is the Stock Repair Strategy? Where we use call options to reduce losses on stock positions. Now, we all know investors that bought stock that went down in value and then decided to buy shares at the lower price so that the average or break even is lower than the current losses. But is there a way where we could lower our break even without putting additional cash into the trade? And I'm here to tell you that there is, using this stock repair strategy. So let's first define the strategy. Now, it starts off with the premise that we're dealing with a stock that has declined in value substantially. And we want to address that by lowering our break-even price. So for every 100 shares that we own, we're going to purchase one call option, giving us the right but not the obligation to buy the shares at the current lower price or a price similar to the current lower price. Now that means we're putting additional cash into the trade, but we can fund that cash from the purchase of the call option by selling two call options. And the amount of cash that we generate from the sale of those two call options should approximately cover the cost of the purchase of the one call option. Now, when we sell a call option on shares that we own, that strategy is known as covered call writing. We are covered because we already own the underlying shares. In this particular case with the stock repair strategy, we're also covered. If we sell two contracts, one contract is covered from the 100 shares that was owned originally, and the other call option that was sold is covered by the option that we purchased that gives us the right to buy 100 shares of the underlying stock. Now, the flaw in this strategy is that it does not protect us from further share price decline. So let's make this all come alive using a real-life example with FedEx Corp, which trades on the New York Stock Exchange under the ticker symbol FDX. Now, FDX was purchased at $235 a share and dropped in price so that on December 7th, 2018, the stock was trading at $201.39. So a very substantial decline from $235 to $201.39. Now, we would like to make that break even much lower without paying any additional money into what is now a losing trade. So we're going to start off by purchasing a near-the-money call option. That means a call option strike price that's close to the current market value of $201.39. In this case, we're going to look at the $200 strike price. Now, if we bought the 100 shares at 200, would currently just have the right to do so, that would lower our cost basis from $235 to $217.50. 235 plus 200 divided by 2, $217.50. Now, remember, we don't want to put any additional cash into this particular trade. So if the 200 strike that we're purchasing costs us $10.90 or $1,090 for the 100 shares, we could sell two contracts of the 210 now out of the money strike, higher than current market value, for $545. So that would actually turn out to be a complete wash because we're generating from the sale of the two call options $10.90, which is precisely what it cost us to purchase the near the money $200 strike. Now, what are our realistic strategy objectives here? Because we are actually locking in this particular case, a loss. Now, what if the price of the stock moves up from its current value of $201.39 up to the strike price of the two short calls, 210 strike? That's the best case scenario. So in that particular situation, our loss before the stock repair strategy was $33.61. That's the difference between the purchase price of $235 to the current market value of $201.39. Now let's look at this trade, the stock repair trade. If the price of the stock moves up by expiration of the contracts to $201.39, well, that means we're going to sell the original shares at a loss of $25. Remember, we purchased them at $235, and the option contract requires us to sell at $210. So that's a loss of $25. Now, the $200 call, when the stock is trading at $210, is worth $10. That would be the intrinsic value component of the premium. So if we have a plus 10 and a minus 25, net, the trade loses $15 a share. Now the cost of the option trade is zero because the two short calls paid for the one long call. So from a net option perspective, we had to pay no money and we benefited by no money. Now the share loss is reduced from $33.61 or 14.3% loss down to $15, which represents a 6.38% loss, less than half. Now I'm not saying that's a reason to celebrate, but certainly a 6% loss is much more palatable than is a 14% loss. Now, the BCI has developed a stock repair calculator that's found in our store. And what we do is we put in the information into the white cells at the top of the spreadsheet, where we see the $235 original purchase price, the $201.39 current market value, the 200 strike that we're purchasing, and the cost of that, which is $10.90. And then, of course, selling the 210 out of the money strikes at $5.45 per contract represents a $10.90 net credit, along with the $10.90 debit, results in zero cost for the options. Now, again, if the price of the stock ends up at $210 or higher, the bottom of the spreadsheet will show a $15 loss, which represents a 6.38% loss. Once again, less than half than what we would have lost had we not initiated the stock repair strategy. So let's sum up. The stock repair strategy is an outstanding way to reduce losses from our long stock positions. We apply it when the decline is significant. And the reduction in the amount of losses is a reasonable target. You know, we're no longer thinking about making money, but we're looking to mitigate our losses. Now, there are situations when the price of the stock has gone down and we could use this strategy and absolutely might end up turning a profit. So that's possible in many cases, but in this case, the original share loss was so spectacular that our goal at this point in time was just simply to mitigate the extent of the loss. Now, once again, it's important to remember that the stock repair strategy does not protect against additional share depreciation. So if the price continues to decline, we might consider selling the stock. All right, so even if we use this strategy, we still have to have an alternative plan B if this doesn't work out. So I just want to remind everybody to learn more about options, and in particular covered call writing and selling cash secured puts. Visit our store at thebluecollarinvestor.com/store. We have a whole series of books, ebooks, DVD programs, calculators, trade planners, and so much more that will help elevate the knowledge of this strategy to a master level. So I want to thank everybody out there for taking the time to listen to this podcast. I hope you enjoyed it, and most importantly, I hope you make some money from it. As always, this is Ellman, the Blue Collar Investor. Take care, everybody.